The total fee earned by Rotunda in the current year is closest to. So what do we have? 288 million in AUM as of prior year end, which is the same as saying 288 million as of the beginning of the year, right? So that is the value at the beginning of the year. V0, we need value at the end of the year. 2% management fee based on year-end assets under management. Do we have a return? Current year fund gross return is 25%. So we can figure out the management fee. All right, now 288 is what we started with, 25%. We end with 360 multiplied by 2%, 7.2 million. 20% incentive fee calculated net of management fee using a 5% soft hurdle rate using a high water mark of 357 million. Well, if it's collected net of management fees, that means we have 252.80. The high water mark is 357. We're below the high water mark here, so the fee here would be 0. We're at 7.2 million, which is A. A hedge fund with net capital of 500 million has borrowed an additional 200 million at 4.5% per annum. The current year return of the fund is 15%. What would have been the return of the fund had not added any leverage. So the leveraged return of the fund is the return of the fund plus, this is the return minus the cost of borrowing times the leverage factor. And we just substitute in what we know. We had 15%, our cost of borrowing was 4.5, and the value of debt over the value of equity, 200 over 500 is 0.4. Expand the terms, collect the like terms, divide through, R is 12%. A common problem for the mark-to-market valuation of private equity funds is most likely a violation of accounting rules. No, it was in accounting rules. We're using level 3 pricing here, so that can't be right. An understatement of portfolio risk. Yes, because when you mark to model, you're losing all of the market volatility that would exist if you had observable prices. An understatement of interim portfolio return. You would actually have an overstatement of portfolio return. B. Okay, this question is long, detailed, and tedious, so I'm not going to walk through it for you, but I will get you started. We have 3 investors, 100 million from A at the beginning of year 0, 100 million from B at the beginning of year 2, and 100 million from C at the beginning of year 3. And we have our annual gross returns given at the end of year 1, year 2, year 3, and year 4. And we can see when the money came in. Management fee is 2% based on end of year value. Incentive fee is 20%. We have a high watermark that we have to observe right here. Calculated based on end of year value net of management fee. We see no hurdle rate. So I'll do the first year for you. We started with 100, 20% return. That means we end the year with 120 million. And you have a management fee of 2%, that's 2.4 million. Since it is net of management fees, you subtract the 2.4 million from the 120, we'll get 117.6. The high water mark must be the 100 million because that's what we started with, and you get 20%. So let's take off the high water mark, 17.6, and you'll get 20% of that. You'll take those 2 fees, whatever you get for this particular fee and whatever you get for this particular fee, and since they go to the GP, you net it out from the 120, so it'll be the 120 minus the management fee minus the performance fee, and that'll be your new high water mark. And then you start year 2. Year 2 had a negative return, so we know we don't have to worry about calculating 20%. There we just figure out what the end of year value is, calculate the management fee, deduct it off, and that would be the starting value for year 3. Add 15% on. Well, we know if we deduct 15%, then take off even more, then add 15% on, we're not going to be back to our high water mark as of yet. You won't have to deal with that till you're at number 4, and then you will calculate the highest net return at the end of year 4. Who has the highest net return at the end of year 4? I'll leave that to you. It is a lot of small little calculations on your calculator, but I've gotten you started. Okay, question is asking us for the total carried interest to the GP. So we have to read what we have here. 8% soft hurdle. Remember, as soon as you cross 8% on a soft hurdle, the performance fee would be on the whole amount, not just the amount above the hurdle. That would be a hard hurdle. Full catch-up. And we have the waterfall structure American with clawback. Carried interest is 20%. It says here 20% above the preferred return, but we have a soft hurdle. So it shouldn't say above the preferred return. You'll notice it. Level 1 this year, there's a whole bunch, like just an unimaginable amount of these sloppy little mistakes everywhere, which makes learning rather difficult, I think. So let's look at our profit for the 5 investments we have, and it's nice that they give us the percentage here. This is over the hurdle, 8%. That's over 8%. That's under 8%, so we get 0. That's over 8%, and that is negative, so we'll have a clawback here. 20 million was the gain. Sold it for 60, invested 40. We have 20. We get 20%. So 20% of 20 is 4 million. 20% of 60 is 12 million. We know we get 0 here. We have 80. 20% there is 16 million. And we're going to have a clawback. Since it was a 10 million loss, 20% of that is 2 million. So it gets clawed back. You get the 30 million. Okay, same question here, but notice that our waterfall structure is European, which is whole of funds. So all we have to do is just go down to the bottom line. We see that we have 160. We look at our return as a greater than 8%. It is. Since it is soft, we get 20% of the whole thing, which is 32 million. Okay, let's end on another mistake. Hedge fund has the following fee structure. Annual management fee, end of year, 2%. Incentive fee, 20%. Hurdle rate before incentive fee collection starts is 4%. It says before collection incentive fee starts. It doesn't tell us whether that's hard or soft. We'll assume that we're dealing with a hard hurdle. And current high water mark is 610 million. The fund has a value of 583.1 at the beginning of the year. After 1 year, it has a value of 642 before fees. The net percentage return to an investor for the year is closest to, and here we're not told whether the performance fee is net or gross of fees, so we're not going to net it out. We'll just leave it there. End the year at 642. Assets under management at year end, 2% fee. Multiply by 2, you get 12.84%. Then it says, then we have to calculate the hurdle rate before incentive fee starts is 4%. So 583, because we start the year at 583.1 times 4% does not get us to 610 million. So we simply just use the 610 million because that is our current high water mark. 642 is over the 610, which is 642 minus 610. And we're not told that it's net of fees, so we're not going to net them out. Multiply by 0.2, we get 6.4. Add them together, 19.24 million. And 642 minus the 19, because that's the GPs, over our beginning amount is 6.8%. I know the reading wants to lead you into the 7.64%, but the 4% return, the 4% hurdle rate, you have to generate a 4% return. The 4% return is on the beginning of the year value, not a 4% return on the high water mark. So that is wrong.